Well, it's been a long time where they've been underperforming. I mean, really for over a decade. And, right now you have some cyclical positives because they'd been in an earnings recession, finally started to come out of that. And you've had the manufacturing recovery in the U.S. finally take hold. The ISM manufacturing indicator is the single most correlated macro indicator with the Russell 2000.
Oh, is that right? Okay.
When we've looked at 30 or 50 different macro indicators. So manufacturing actually matters a lot for that index. And then you had, oil prices higher. The Russell 2000 actually has more exposure to industries that benefit from higher oil than the consumer industries that get hurt by it. And then, performance was actually a bit more concentrated than usual. So when you look at a lot of the top performers, it was actually some of the thematic AI infrastructure stocks that were some of the biggest contributors. So even though the index is up so much this year, I think there are parts of the index that could still play catch up. Healthcare has been underperforming, but M&A activity.
12 years.
Yes. And healthcare and biotech had not looked particularly attractive in our work in small caps, but finally are starting to.
The rep is there's no profit or less profit. How does profit play across successful and less successful Russell 2000?
Yeah, the index is, about a third of the companies are non-profitable. So that is historically elevated. We obviously just went through 2 earnings recessions, COVID, and then the recent one that started in, 2022, 2023. And you also had an IPO boom in 2021 that caused a lot of non-profitable stocks to get added. So the amount of stocks that don't have earnings is elevated. It's starting to come down, and even for an area like biotech is actually the highest quality it's been in about 12 years. You're starting to see more companies turn profitable, get more mature. But we did see this sort of, unprecedented period of low quality outperformance within the small cap index over the past year or so, where, usually if you're a small cap investor, you want to own higher quality stocks because the profitable stocks, the higher quality ones, do tend to do better over the long term, but that's not what we saw over the last year or so. So that kind of 3 standard deviation event and how much low quality stocks outperformed, I think now kind of paves the way that we could go back to a more normal environment where higher quality stocks work within small caps in the second half.
I learned early in my career, SMID means small mid-cap. That's a cool term. Now, for you, Jill, in the first half, you preferred small versus mid-cap. Now in the second half, you're saying mid-cap versus small. Why?
Yeah, I think even though we do still think that both small and mid-caps could outperform mega-caps in the second half, you're still expected to see a big profits pickup in small and mid-caps to kind of similar levels that should outpace large-cap profits in the second half. We saw much better performance for small caps in the first half. So I think just performance-wise, there's more catch-up potential now for mid-caps on a similar level of profits. And we're seeing Fed hikes start to get priced into the market. Our economists at B of A now expect the Fed will hike 3 times this year toward the end of the year. Russell 2000 has a lot more leverage, a lot more refinancing risk, given the debt exposure is more towards short-term and floating rate debt. So I think given those increased risks from higher rates, we'd tilt more toward the mid caps than the small caps for the second half, just given those risks.
Do their executives, particularly in mid cap, striving every day? They've got their hurdles, their equity kickers, and all that. Do they do M&A like big caps? I mean, are they essentially equivalent, or is it a whole different world?
I mean, right now, a lot of the deal activity is, small caps are the targets, and a lot of the larger companies are the acquirers. So you have a lot of large pharma buying smaller biotech. That's been a key area of activity. So while you may see some in mid, that a lot of the activity is large buying small, and that's where the relatively cheaper valuations are as well. Mega caps are the most expensive area. Small caps are kind of the least stretched, although now small and mid are kind of trading at similar valuations.
You have one of the coolest double majors going. You're at Lafayette. Were you in economics and said, I'm going to take a double major in English? Or were you in English saying, I'm going to take a double major in economics?
I was econ and math, and then I decided to drop the math and picked up English. I always liked writing, so I decided if I was taking some writing courses, might as well make it a second major. So.
You got to your Schrodinger equations and differential equations and said, I think I'll study Shakespeare.
I got to Calc 3, and then I said, I think I've had enough.